What is a stock index? A stock index is like a scoreboard for the stock market. Instead of tracking just one company's share price, it shows the combined performance of a group of companies. Each index follows a different basket of shares, such as the biggest companies in a country, or those in a particular industry like technology or energy. Why does it matter? Indexes give us a quick way to see how the market or part of it is doing. If you hear the FTSE 100 went up today, that means the 100 largest companies listed in the UK rose in value overall. Other well-known examples are the S&P 500 in the US, which follows 500 big American companies, and the Nikkei 225 in Japan. This matters because many pensions, ISAs, and investing platforms use index funds in the background. So even if you've never chosen a single share, your savings might already be linked to one. And for everyday investors, an index helps cut through the noise of hundreds of different share prices, giving a single snapshot that feels less overwhelming. Here's a simple example. Imagine an index that tracks just 3 companies: a supermarket, a bank, and a phone company. If the supermarket's shares go up by 10%, the banks go down by 5%, and the phone company stays the same, the index might show a small overall rise. Instead of checking each company one by one, the index tells you the general direction in a single glance. You can also think of it like a fruit basket. You don't need to inspect every apple and banana or grape separately. You can instead just look at the basket as a whole to judge whether it's fresher or riper today. What else should you know? Indexes are a helpful guide, but they aren't perfect. Not all companies are included, so an index might not show the whole or true picture. Some companies in an index count more than others, usually because of their size. Also, just because an index is rising doesn't mean every single company in it is doing well. And while investing in an index fund can be safer than betting on one company, values can still fall if the whole market drops. That's why index investors often focus on indexes over years or decades, rather than stressing about daily ups and downs. Can you invest in an index directly? Not exactly. An index is just a number. As I said at the beginning of the video, it's like a scoreboard showing how the group of companies is doing. You can't buy the scoreboard itself. What you can buy are index funds or ETFs. These are investment products that copy an index by holding the same companies inside it in the same proportions. For example, an S&P 500 index fund will own shares in all 500 companies, so when the index goes up or down, your fund should move in roughly the same way. That's why when people say they're investing in the S&P 500 or tracking the FTSE 100, what they really mean is they've bought into a fund that mirrors that index. To sum it all up, a stock index is a way of measuring how a group of companies is performing, giving us a snapshot of market trends. It simplifies a complex system, shows up in many everyday investments, and helps us focus on the bigger picture. But it's only one tool among many to understand the world of investing. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.